Hey everyone, welcome back. Ready for another deep dive?
Definitely.
So it's this English learning podcast called Daily Money Briefing.
Huh. Interesting. Okay.
It's actually pretty cool. You get the
Yeah.
financial news and kind of a language lesson all in one.
Oh, I like that. Sort of killing two birds with one stone.
Exactly.
Okay, so today we're zeroing in on some really interesting signals coming out of Asian markets.
Yeah, we're looking at Japan's bond markets, some moves there. Also South Korea, their economic outlook, and this push into digital assets.
Exactly. We've got a few reports. And our goal is really to, connect the dots, see what these seemingly separate things might mean for the wider global economy. I'm ready to unpack this.
Absolutely. It's quite striking how interconnected everything is. Japan just hinting at something about its bond issuance caused a pretty big reaction globally.
It did. Japan's Ministry of Finance, they reached out to market participants asking about the, quote, appropriate issuance volume for Japanese government bonds, or JGBs.
Mm-hmm.
A subtle hint, maybe, that they might issue less. Now, for you following along, bond yields, that's the return investors get. So if the ministry suggests issuing less, what happened then?
Well, we saw yields on the longer-term bonds,
Yeah.
especially the 20-year JGB, drop quite sharply. It was actually the steepest fall in months, down as much as 21 basis points at one point.
Yeah. Okay. And remind us, falling yields mean?
Falling yields mean rising bond prices. They move in opposite
Right.
directions, so it really suggests the market is super sensitive to any hint of a change in Japan's, long-running easy money policies.
Right. And this wasn't just contained to Japan, was it? We saw ripple effects.
No, definitely not. Yields on 10-year U.S. Treasuries also dipped about 6 basis points. Same story in Germany, and the UK benchmark yields fell there too.
So why does a potential tweak in Japanese bond supply affect U.S. or German bonds? What's the connection?
Well, one line of thinking is that if there are fewer JGBs being issued, Japanese investors who are huge players globally might look elsewhere for yield.
Ah,
And that could mean potentially less competition for assets like U.S. Treasuries, making them maybe slightly more attractive. It just shows how linked global capital flows really are.
fascinating. So Japan's market causing these global waves. Let's shift gears a bit to South Korea, another major player, but a different story unfolding there, especially with digital assets.
Yes, quite a contrast. You've got real political momentum building. Presidential candidate Lee Jae-myung, for instance, has been pushing for a Korean won-based stablecoin market.
A stablecoin. So that's crypto tied to the value of the won, right?
Exactly. The idea is to keep national wealth, from flowing overseas into other crypto assets. And also, frankly, to address the feeling that Korea is maybe lagging a bit behind the U.S. in getting its crypto regulations sorted out.
Interesting. And it's not just talk, right? There's a concrete proposal, too.
That's right. The Democratic Party suggested launching a public-private digital asset exchange. It seems part of a bigger plan to really boost South Korea's digital finance sector.
And the context here is important. How many crypto investors are we talking about in South Korea?
It's a significant number. Reports suggest over 16 million people there are involved in crypto investing.
Wow.
So yeah, proponents believe if they coordinate this properly, South Korea could really become a major digital asset hub in Asia.
Okay, so a strong push into the future of finance. But at the same time, we're hearing some less positive news about their traditional economic pillars.
Yes, that's the other side of the coin. A recent report from the Korea Institute for Industrial Economics and Trade, KIET, it paints a concerning picture.
How so?
They're projecting that 9 out of South Korea's 13 major export industries could face headwinds in the second half of 2025. Total exports are predicted to fall this year overall.
And that impacts growth.
Significantly. They expect real GDP growth to slow to just under 1%, 0.95%. And these aren't minor sectors. We're talking about industries that make up almost 80% of their total exports.
Like which one specifically?
Well, the projections show declines in key areas like automobiles, machinery, steel, petrochemicals. That one's expected to be down quite a bit, nearly 20%, textiles, home appliances, displays, even secondary batteries.
That's a broad range of core industries. They actually revised their overall export forecast down quite a bit then.
They did, by about $22.7 billion, or 30 trillion won. It definitely signals potential pressure on policymakers to find, new growth engines.
Which brings us back to the digital assets push, perhaps. How do these two things, the digital ambition and the industrial headwinds, connect?
That's the key question, isn't it? Could this stablecoin platform, this digital finance ecosystem, provide a new avenue for growth? Could it maybe offset some of the pain from the traditional export slowdown?
Or maybe help with capital outflow concerns if those industries struggle.
Potentially. It's this really interesting tension. South Korea seems to be looking towards digital innovation, while its established industrial base faces some serious challenges.
So summing up then, we have Japan signaling potential bond market stability, which has these immediate global effects. And then South Korea pushing hard on digital finance while simultaneously dealing with significant headwinds in its core export sectors.
Exactly. The interplay is fascinating. And it leaves us with a big thought, doesn't it? Well, as these traditional economic drivers maybe sputter a bit in some major Asian economies, you have to wonder how much these innovative approaches, like digital asset markets, could reshape not just their future, but their influence on the whole global economic stage.
A really crucial question to keep an eye on.
Thanks for diving deep with us today.